On March 25th, global financial markets violently snapped from a state of stagflationary panic into a sharp, immediate tactical relief rally. The specific exogenous shock driving this de-escalation arrived in the form of U.S. President Donald Trump's 15-point peace plan directed at Tehran. In immediate response, Iran agreed to allow non-hostile oil vessels to transit safely through the Strait of Hormuz, reopening this critical maritime energy corridor. This neon line chart shows the exact pricing reaction. Brent Crude, the global benchmark for oil prices, drops in a sheer cliff from $108 down to the $95 level, instantly stripping the structural war premium from the market. This geopolitical de-escalation triggered a massive cross-asset liquidity shock. Institutional capital across the globe was forced to rapidly reallocate its defensive positioning. Understanding this precise transmission mechanism, from the macro collapse of energy prices down to granular sectoral rotation, is essential for any institution navigating the resulting short squeeze cycle. To see how this capital moves, we have to scale out to the global level. The new $95 Brent Crude baseline acts as a variable transmission mechanism to international equities, dictated entirely by a nation's energy dependency. The Japanese Nikkei 225 surged 1.46%. As a maritime-sensitive economy heavily dependent on imported crude, securing its critical energy supply delivered an immediate structural benefit to Japanese equities. Europe experienced a parallel relief rally. Germany's DAX began digesting the input cost reduction for its heavy industrial core and chemical manufacturers, lifting the index directly. The United States S&P 500 tells a different story. The American index remains trapped in a strict liquidity pincer. On this split-screen chart, oil prices are cooling, but the 10-year Treasury yield remains stubbornly high, pressing against equity valuations. The Fed's higher-for-longer stance enforces a hard resistance barrier near the 6,700 moving average, definitively capping the upside for growth sectors. While energy importing nations saw immediate structural relief, U.S. markets remained constrained by domestic monetary policy. This dynamic forced global capital to hunt for alternative returns in emerging markets. The Indian Nifty 50 serves as a high-resolution laboratory for tracking this capital flight, particularly during the peak panic of the March 20th session. This chart tracks institutional flow. The magenta bar shows foreign institutional investors liquidating 5,518 crores to chase soaring U.S. Treasury yields. To execute this exit, FIIs used highly liquid assets like HDFC Bank as a liquid ATM, driving a 2.15% drop. HDFC Bank's decline was a purely mechanical, liquidity-driven event. It had zero connection to the actual health of the bank's domestic loan books. The opposing force came from domestic institutional investors, or DIIs. These local funds deployed 5,706 crores to aggressively absorb the dumped supply. This chart plots the domestic wall of money creating a structural floor for the Nifty 50 at 23,200, preventing collapse. The resulting weekly long-legged doji features long wicks, signaling peak structural indecision between foreign panic and domestic absorption. This exact mechanical absorption by domestic institutions is what primed the market's architecture for the violent short squeeze we see today. To understand how the market priced the war risk, we have to look beneath the broader index level of the March 20th sell-off to analyze a highly anomalous sectoral rotation. The standard macroeconomic baseline dictates that IT and metals typically decouple during a global growth shock or a standard risk-off environment. This matrix displays the anomaly. IT and steel giants tightly clustered, surging simultaneously. Institutions deployed a dual hedge. The currency hedge saw IT track rupee depreciation against the dollar. The supply chain hedge saw metals price in ferrous shortages from the maritime blockade. Institutions paired this aggressive defensive posturing with the active liquidation of rate-sensitive financials like Shriram Finance, which suffered under the Federal Reserve's hawkish tone. Capital then rotated heavily into domestic energy, specifically establishing Coal India as the ultimate old economy safe haven play. The logic here is absolute energy independence. Coal India's internally domestic supply chain made it completely immune to Middle Eastern maritime transit chaos. Institutional Flow surgically engineered a resilient portfolio designed specifically to survive a prolonged maritime conflict. Today, on March 25th, we see the explosive upward momentum as the Nifty officially executes a massive 2% short squeeze recovery. The mathematical resolution of the previous week's indecision is a 480-point Nifty surge, successfully reclaiming the 23,350 base as the war premium evaporates. However, despite the tactical euphoria of the peace plan, the fundamental geopolitical landscape remains brutally complex and highly volatile. The persistent forward risk centers on Israel's simultaneous tactical strike on a naval missile production site located in Tehran. This direct strike guarantees that the structural war risk premium will not be entirely erased from regional energy assets. This nifty forward projection chart plots actionable parameters. Expect a profit-booking zone as the index nears the 23,500 to 23,600 resistance levels. Preferred tactical sectors for rotation are pure fuel cost beneficiaries, aviation, and paints. Finally, maintain strict trailing stop losses at the 23,100 support floor. The Hormuz peace pivot offered an immediate and highly lucrative liquidity relief rally. However, advanced tape reading requires constant vigilance against sudden headline retaliation, as maritime security remains the primary driver of global price discovery.